In this video, I'll tell you everything you need to know about REIT investing for beginners. Make sure you stay until the very end where I share some of the best REITs to buy. And before we get started, please give this video a thumbs up and subscribe and click the bell. That way you'll be the first to see my next money-making video. A real estate investment trust, or a REIT, is a company that owns and in most cases operates income-producing real estate. REITs are the most common type of real estate company. There are a number of different kinds of REITs, but each company's business model may be simplified to the following: making money from real estate assets. The majority of REITs own real estate assets and rent them out to generate income. Their goal is to own physical real estate to lease for profits. Mortgage REITs, on the other hand, provide financing for individuals to purchase income-producing real estate. How to invest in real estate investment trusts. REIT investing is similar to stock market trading. REITs are structured after the same mutual funds that are familiar for the majority of people. The funds invested in shares are allocated to the REIT's chosen assets. The REIT chooses where to put the money that the investor gives them. Investors may invest in real estate through REITs without having to acquire physical assets. Investors just need to create an account with the broker, be mindful, and make wise investment decisions. There are several additional factors to consider, but that's the basic idea. REITs, like every other kind of investment vehicle, entail a certain degree of risk. Investors must be aware of this danger and realize that the correct training and information may help to lower their chances of a loss. However, a well-planned investment approach may lead to years of handsome returns. Are REITs good long-term investments? REITs can be rewarding long-term investments, but not in the way that you might think. REITs depend on dividends to satisfy investors, whereas the most appealing long-term stock investments result from decades of growth. REITs are obligated to pay at least 90% of their taxable income as dividends to shareholders. This puts a restraint on the growth potential of almost all REITs companies. REITs do not have to pay corporate taxes in exchange for paying dividends to their investors. This doesn't mean that REITs can't have a lot of growth potential, but rather that the most appealing aspect about investing in REITs for an extended period of time is the accumulation of dividends. A REIT dividend is paid to all shareholders and is distributed either quarterly, monthly, or annually. The REITs company has the choice of the number of times it distributes dividends. REIT dividends are typically larger than their stock counterparts and occur more frequently. In July 2020, traditional stocks had a 1.68% dividend yield, whereas qualified REITs had a significant higher dividend yield of 4.06%. Income investors are individuals who invest in REITs, also known as real estate investment trusts. With many excellent REITs, there's no reason today's REIT portfolios couldn't produce enough passive income to replace a full-time salary. That's why they consider it income investing. To optimize long-term growth, pay attention to growth potential, where the REITs are investing in growing markets, and the REIT's record of dividend payments and growth. You can learn a lot by looking at the REIT's credit ratings. You want investment-grade credit ratings. Especially look for quality and duration to maximize your return on long-term REIT investments. Investing in REITs versus real estate. Investors who buy real estate investment trusts can benefit from the growth of the real estate sector without having to acquire any actual properties. Those investing in REITs can actually invest in companies that invest themselves. Investors who purchase real estate through a REIT can profit from a market that has performed well in the past without having to acquire property. Physical real estate, on the other hand, will place a lot more power in the hands of the investor. Real estate investors are more likely to have a bigger influence on their own investments. Therefore, their success and failure are mostly dependent on their actions. Real estate investors buying physical properties have shown that flipping can produce good returns even though this is a more active job. There is no winner to be announced when it comes to investing in REITs versus real estate. Both investment opportunities have proven they would make a positive asset to any investment portfolio. The question you need to ask yourself is, would you like the more passive role of REIT investing or the active participation required for physical assets? Types of REITs. REITs are one of the simplest methods for real estate investors to gain exposure to a wide range of sectors. Commercial properties, shopping malls, single-family homes, movie theaters, and just about any other kind of income-generating property are all suitable investments. There's even more variety offered up by the type of REIT investors choose. The 4 types of REITs are: 1. Public non-listed REITs. 2. Private REITs. 3. Equity REITs. And 4. Mortgage REITs. So let's talk about number 1, public non-listed REITs. Public non-listed REITs own and manage income-producing real estate portfolios. The U.S. Securities and Exchange Commission has a number of restrictions and requirements for non-listed real estate investment trusts. Because these REITs are not listed on the stock market, they must make frequent Securities and Exchange Commission reports, which makes them less liquid. Number 2, private REITs. Private REITs are exempt from Securities and Exchange Commission registration and do not trade on national stock exchanges. Private REITs do not need to publicly announce financial reports and are generally reserved for institutional investors. Number 3, equity REITs. The majority of publicly traded REITs are equity REITs, which make up the bulk of the major market indices today. Equity REITs are prominent among firms that own or manage income-generating real estate assets. Investing in equity REITs is investing in companies that invest in portfolios of income-producing real estate. When companies put their money into real estate, equity REITs are frequently in charge and operate property in each major sector. Shopping centers, office buildings, and apartment complexes are all ordinary holdings for equity REITs. The minimum payout requirement for equity REITs is 90%. Number 4, mortgage REITs. Mortgage REITs invest in mortgages and mortgage-backed securities. These REITs function as the bank and collect interest on the financing they provide for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities. Put simply, mortgage REITs invest in mortgages. Mortgage REITs can sit back and collect interest on the money they lend out by being a source of capital for other real estate investment trusts. Pros and cons of REIT investing. As with any investing, there are some pros and cons that need to be looked at even when investing in a REIT, although many investors will imply that the pros greatly outweigh the cons. REITs are a wonderful way for investors to take advantage of the real estate sector's history of success, but investors must do their own research. So here's a list of REIT investing pros and cons. REIT investing pros. Even the most novice investors will be drawn to the benefits of REIT investing. Here are some of the most common reasons why individuals choose to invest in real estate investment trusts. Diversification. REITs allow investors to buy into a broad range of industries and even different REITs. Investors may choose to invest in REITs focused on income-producing properties or ones focused on mortgages. Not only that, the REITs themselves are about as diverse an industry as any other. You can invest in everything from movie theaters and malls to commercial properties and apartment buildings. Liquidity. REITs are incredibly liquid since they're on many major stock indices. Unlike actual property, the cash stored in REITs may be obtained with minimal effort and speed. Therefore, transferring capital or reinvesting it isn't hard, at least compared to other investment modalities. Dividend-based income. Companies that wish to be classified as REITs must pay at least 90% of their taxable income to shareholders. The disbursement of funds that REITs are required to keep up is a fantastic wealth-building tool for knowledgeable investors. Dividends can significantly boost an investor's bottom line, and it certainly doesn't hurt that REITs must pay them. Transparency. Most REITs are overseen by the Securities and Exchange Commission, which mandates that they provide important data such as earnings statements, so there is a lot more transparency in the realm of REITs than there is in several other investment vehicles. Outside of determining the general market, most investors know what to expect. History of competitive performance. REITs have historically outperformed the returns paid out by equities that are regularly traded in the United States. REIT investing cons. There are drawbacks to consider alongside the benefits of investing in REITs, and they're worth considering. Here are some of the cons you should think about before making any major decisions. Susceptible to market fluctuations. While the performance of REITs are typically connected to the real estate sector, they can be affected by market volatility from time to time. Interest rates. REITs' performance is intrinsically related to interest rate movements. When rates increase, they cut into the profit margins of REITs. It is worth noting, though, that interest rates usually rise when the economy is strong enough to handle them. Tax exemptions. Some of the dividends paid to shareholders are taxed at a rate comparable to that normally applied to ordinary income, whereas most other dividends are taxed at a much lower rate. Limited growth potential. Their upside is restricted by the very thing that attracts investors to them, which is dividends. REITs are their own worst enemy since they have less money to reinvest in their own company. It's a double-edged sword. Now, before I tell you what the best REITs are to buy, please give this video a thumbs up and subscribe and click the bell. That way, you'll be the first to see my next money-making video. Also, type the word yes down below if you are going to start investing in REITs today. What are the best REITs to buy? The best REITs to buy are entirely up to each individual investor. Some REITs offer more growth potential without high dividend yields, while others are better for income investors. Today's most popular REITs are not necessarily the finest REITs to hold in the future. Even though the stock market is impossible to predict, REITs are typically stable and illuminate investors to benefits across multiple industries. You can diversify your portfolio across some of the fastest growing sectors like data centers, industrial warehouses, and life science spaces, said Deirdre Woolard, host of Millionaire Acres podcast. It is impossible to predict the future of REITs, and anyone telling you so is a fool. However, it is possible to look at up-to-date trends and reach a conclusion over several years. And remember to always seek professional help before making any decisions with your finances. That in mind, these REITs look positioned for a long, prosperous run. American Tower Corporation, Americold Realty Trust, Stag Industrial Inc., Digital Realty Trust Inc., UMH Properties. If you're interested in living off of dividends, click the video on the screen. Here I'll tell you how to live off dividends and how much money you need to do it.